Hello and welcome everyone. Thank you for joining us for today's Baron FinTech webinar, the final session in this quarter's Portfolio Manager Update series. I'm Liz Castle, Vice President for the Pacific region for Baron Capital, serving the RIA, Family Office, and Bank Trust channel. I'm delighted as always to be here with my partner Josh Saltman, Portfolio Manager for the Baron FinTech Fund. Josh has been with Baron for over a decade and has managed Baron FinTech since its inception at the end of 2019. Thanks for joining us, Josh.
Hi, Liz. Great to be with you again.
Thank you. Before we jump in, one quick note. If you have any questions you'd like to ask during the presentation, please type them into the question box in your Zoom control panel or email them to questions@baronfunds.com and we can address them during our session. And of course, you can follow along with more information about the Baron FinTech Fund, along with all of our funds at www.baronfunds.com. So, Josh, with the last 18 months having been exceptionally challenging for equity investors, I think it might be helpful to start with your thoughts on how the environment has changed, where we are in terms of market cycles, and your thoughts on the quality of the portfolio.
Sure, Liz. Look, the market environment is pretty mixed right now. Financial conditions are tightening, and there's growing concern of a recession. In response to high inflation over the last couple of years, the Fed has increased the overnight rate by 5 percentage points over the last 12 months, representing the largest increase and fastest increase since the 1980s. The yield curve is deeply inverted and growth is slowing across a number of different businesses. That being said, I think a lot of this weakness or concern is reflected in the equity markets, which peaked about 18 months ago. Since Q4 of 2021, the S&P 500 is about 15% off its peak. The Russell 2000 Small Cap Index is 30% off its peak, and the FinTech Index is about 40% off its peak. So a lot of pessimism already reflected in share prices today. We don't try to predict what the equity market or the economy will do. We instead apply the traditional Baron philosophy of investing in businesses with long runways for growth, sustainable competitive advantages, run by outstanding management teams, and invest at reasonable valuations. The near-term outlook is pretty uncertain, and so the fund is positioned more defensively than usual in what we believe are the highest quality, most durable businesses in the fintech industry. About 3/4 of the fund is invested in leaders, which we define as larger, more established businesses, while the remaining quarter is invested in challengers, which are generally earlier stage, faster growing companies. And your question about the quality of the portfolio, we feel great about it. Compared to the fintech benchmark, our companies are growing faster. Top line growth is 18% versus 14% for the benchmark. Our companies have higher operating margins, 26% versus 10%, and higher returns on equity, 18% versus 5% for the index. So feel very strongly about the quality of the portfolio.
Excellent. And I think it's worth highlighting that the fund has outperformed the benchmark over every major time period, the 1 year, 3 year, and since inception periods. But we did underperform in the first quarter of 2023, largely as a result of not owning many of last year's biggest losers in the benchmark that have since rallied to become this year's biggest winners. Are you considering adding any of those names?
So in the 3 years or so since inception, the fund's cumulative return is 19% versus the fintech benchmark, which is down 7% over that same period. So we've outperformed by a healthy margin. And our analysis shows that the Baron FinTech Fund has been the top performing fintech fund in the market since inception. So we feel great about longer term returns. In Q1 of this year, though, the fund was up 5%, compared to an 8% gain for the fintech benchmark. So we modestly underperformed by about 3 percentage points. Our goal is to generate above average returns over a full market cycle. So we're really not concerned about a single quarter or even a single year. We're far more focused on returns over a 3 to 5 year time horizon. However, when we examined the numbers for the first quarter, we observed that the biggest winners in the benchmark had been the biggest losers last year. And these tended to be smaller, more speculative stocks that we just didn't own. I mentioned earlier about our relatively defensive positioning, and that also weighed on performance, at least relative to the benchmark in Q1. Our challengers were up 9% versus our leaders only up 4%. I think that this is normal quarterly volatility, and we haven't made any meaningful changes as a result. And we've already seen relative performance, that relative performance gap narrow in April.
So you're not adding those names, but can we talk about any other major changes you're adding to the portfolio recently? I know that last time we spoke, you mentioned having added some defensive stocks as shock absorbers in a rising rate or idiosyncratic growth environment. How are you positioning those names as we look toward the second half of 2023?
You know, Liz, what's great about FinTech is that it's a remarkably diverse category with many different business models driven by differing growth drivers. What underpins our investment approach is owning businesses that are likely to grow at rapid rates over many years, even though those growth rates could speed up or slow down depending on economic conditions. Over the last year, we've benefited from owning several stocks that do well in a rising rate environment, generally those that earn higher interest income on idle client cash. If we go back to a rate cutting cycle later this year or next year, those businesses likely won't grow as quickly, but others in the portfolio will see faster growth. So the overall portfolio doesn't just rely on a single set of economic conditions to thrive. We also own stocks with more idiosyncratic growth drivers. So a few examples of those would be our insurance companies like Progressive and Kinsale Capital, who are benefiting from a hard insurance market where they're seeing significant price increases. This hard market is driven more by the supply of insurance capital than it is by overall economic growth. And so the success of those businesses will really be driven by more idiosyncratic factors. We also own financial exchanges such as the CME, Market Access, and TradeWeb that benefit from periods of elevated market volatility like what we've seen recently.
The biggest shock to capital markets this year has come as a result of turmoil in the banking sector, of course. Can you give us your thoughts there? And do you think the issues we're seeing will create opportunities for fintech challengers to gain share from legacy players? Or do you think it's more likely that markets will favor the proven incumbents in a flight to safety?
Yeah, so this turmoil in the banking sector really started in early March with the failures of a few regional banks, specifically Silicon Valley Bank or SVB, Signature Bank, and then more recently, First Republic. We also saw the failure of a smaller crypto-focused bank, Silvergate. SVB, Signature, and First Republic, they had relatively unusual deposit bases that were concentrated in a small number of larger customers. And once those depositors got spooked, they quickly withdrew their deposits, causing bank runs. And there's no bank that can survive a run. I think it's important to note that the turmoil we're seeing today is very different from what we saw 15 years ago during the Great Financial Crisis. Back then, there was a problem on the asset side of bank balance sheets where they owned complex, toxic assets that lost value. Today, the issues are more on the liability side of bank balance sheets, where their deposits haven't been as stable as investors or managements thought they were. But actually, the asset side of the balance sheets, their securities portfolio, have actually been quite good, even though they've lost value in the near term from rising interest rates. Stepping back, our expectation has been that SVB, Signature, and First Republic are unique situations and that we won't see a flood of other bank failures. But there's certainly potential for this turmoil to spread to other banks that have similar profiles. We think this is really just a crisis of confidence, and human psychology is difficult to predict. So we're cautiously optimistic, but think that strong action by the FDIC, the Federal Reserve, and other government agencies to increase deposit guarantees would certainly help the situation. But even if there are no more bank runs, banks are facing headwinds to their earnings and capital bases from higher funding costs and potentially more onerous regulatory changes. I should note that Baron FinTech Fund, we don't own any regional banks, so we're somewhat insulated from these challenges. Now, we do own software companies that sell into these banks and provide necessary solutions to those banks to help them run more efficiently. And at least so far, we haven't seen any slowdown in the sales cycles or revenue growth for these software providers, which has been a pleasant surprise. So in conclusion, I don't think that the current situation in the banking system changes the competitive balance for incumbents versus challengers. I think that both can thrive, where incumbents benefit from distribution and established trust, while challengers are generally more innovative. So I think that the share shift between them will really be company specific.
Excellent. It's amazing to think that that was 15 years ago, but those are great points for the differences. Switching gears a bit, can you take us through our new investments in Interactive Brokers Group and Apollo Global?
So Interactive Brokers is the low-cost, low-price brokerage firm. It serves both institutional and individual investors who want to trade stocks, bonds, options, and foreign currencies from a single platform. Now, what's distinctive about Interactive Brokers is its singular focus on using technology to reduce trading costs and then passing along those savings to its customers. So Interactive Brokers has automated many of the processes that competitors do manually. And then Interactive Brokers shares some of those savings with its own customers by charging very low commission rates, very low margin rates, while paying the highest yields on customers' cash balances. What's also distinctive about Interactive Brokers is its global customer base. They serve customers in over 200 countries, and about 3/4 of their customer base is located outside the US. So outside of large investment banks, there are very few brokers that operate across multiple countries. Interactive Brokers is able to provide these services because they've made the necessary investments over many years in operations and technology to profitably serve all these different markets. They have 2 million customers today, which is quadrupled over the last 5 years. And we think that Interactive Brokers can continue growing its customer base over 20% for many years to come. The company enjoys a sustainable cost advantage from its use of technology and automation, and it's run by an outstanding founder and chairman, Thomas Petterfy, who's been a visionary in the securities industry and still owns 70% of the company. And we view valuation as very attractive at 13 times earnings today. So the other new addition to the portfolio in Q1 was Apollo Global, which is one of the largest alternative asset managers in the world with $550 billion of assets under management. And while its roots are in private equity, Apollo primarily focuses on private credit, which is a much larger and steadier business than private equity. But due to onerous regulations that have been enacted since the great financial crisis, banks have really retrenched from making loans to small and mid-sized businesses. So more lending is shifting outside of the banking system towards non-bank lenders like Apollo. And then within its lending business, most of its assets are actually in highly rated low-risk loans. And the relative safety of these loans makes them a good fit for retirement products with predictable long-duration liabilities, such as annuities and pension funds. So the addressable market for these low-risk fixed income investments is massive. It's about $40 trillion, which provides a very long runway for growth, particularly relative to Apollo's $500 billion assets under management. It has sustainable competitive advantages from its years of experience in private credit investing, where it has consistently outperformed its benchmarks. Apollo has a large and growing pool of managed assets that are coming from annuities, which provides semi-permanent capital that enables Apollo to invest in illiquid assets with higher expected returns. In addition, Apollo has proprietary origination capabilities to lend directly to small and mid-sized businesses and generate these attractive, stable, spread-based returns. Apollo is run by CEO Mark Rowan, who co-founded the company in 1990, spearheaded the move into managing insurance assets, and owns 6% of the company. So by 2026, management expects assets to nearly double to over $1 trillion, and earnings per share are expected to grow at a mid-teens annualized rate to over $9 per share. And we think that valuation is highly attractive today at just under 10 times earnings.
We've talked before about the 7 themes established in the fund. We certainly don't have to go through all of them, but are there a few you might want to point to as particularly exciting right now? Or is there anywhere you want to give an update from a thematic perspective?
Sure. So just briefly, our payment companies continue to benefit from healthy consumer spending trends. They're protected from inflation because their volume-based revenues rise along with higher prices. And several of our payment companies are benefiting from the rebound in international travel as countries reopen their borders and people are eager to explore the world again after being locked down for years during COVID. Within the e-commerce segment, we're seeing our e-commerce businesses like Shopify, Adyen, and Mercado Libre, they're seeing a rebound in online shopping growth. There was a huge pull forward in 2020 and 2021 during the early days of COVID that created really rapid growth during those years, but then difficult comparisons in 2022 that led to underperformance of these stocks. Well, now in 2023, we're in a more normal environment where e-commerce continues to grow faster than total retail spending. And so we're seeing growth rates rebound to low to mid-teens growth rates across the industry. Within information services, it's quite diversified, but we're seeing favorable trends emerge for a number of our holdings. S&P and Global and Moody's are rating agencies that earn revenue based on rated debt issuance, which declined a lot last year, but is now showing signs of improvement as markets adjust to the current environment. Verisk Analytics has been far more stable and is actually showing faster organic growth due to the resilience of its insurance end market. And finally, within capital markets, our financial exchanges and trading platforms are benefiting from higher trading activity during periods of elevated market volatility.
Wonderful. I noticed that the fund's exposure to financials came up dramatically over the past quarter. It's now 65% compared to 37% just 3 months ago. Am I correct in thinking that that's just a result of the changes in GICS classifications? And for anybody who doesn't know, can you take us through what exactly changed as far as the stocks are categorized according to GICS?
Yes, that increase was largely due to a technical change in industry classifications. So for those who don't know, GICS or GICS is an acronym for the Global Industry Classification Standard, which is a system for categorizing public companies by sector. In March, GICS changed the industry classification for a number of fintech stocks from information technology to financials. All of our payment stocks and a few of our enterprise software stocks were migrated into the financial category, which collectively represents just over 25% of the fund. So this had the effect of increasing our financial exposure from 37% at the end of last year to 65% today. This change is largely semantic and doesn't change our investment philosophy. What I think this change does represent is the true hybrid nature of fintech across both financial services and technology, which makes a lot of these stocks somewhat difficult to classify. But we think fintech really represents their true nature.
Thank you for that. Well, as is tradition, I wanted to ask you about cryptocurrency and recent developments in that space. It's an area where we still get a lot of questions from clients between the FTX blow up and a broader regulatory crackdown. Have your thoughts on cryptocurrency or blockchain changed at all?
Not so much. Crypto continues to be an area that we monitor, but it's been less fruitful from an investment perspective. And why is that? 14 years since the launch of Bitcoin, we still don't have a solid use case for crypto or an established regulatory regime. And since the collapse of FTX last year, the SEC has taken more aggressive actions against crypto-related businesses, which suggests that any future regulations will be more punitive for the industry, at least here in the US. So we think that the regulatory environment needs to be better established before we can evaluate long-term investments in the space.
Got it. Thank you. Speaking of innovative technology, AI seems to be having a major moment in the spotlight lately. How do you see the integration of AI into the fintech sector, and how will that play out? How much do you expect it to disrupt the way fintech companies do business?
Well, predictive artificial intelligence has been with us for decades. I think the big changes that we're seeing today are in generative AI. An example would be ChatGPT. And generative AI refers to the ability to generate new content, such as images, text, or video. After speaking with many of our companies about this phenomenon, we've learned that many of them have been applying predictive AI for many years now. For example, Intuit uses AI to distill insights from its large troves of data and provide recommendations to its small business customers. Visa and MasterCard, they both use AI to monitor payment transactions for suspicious activity and then flagging that for further review. And our IT services companies like Accenture and Endava have AI experts on staff who help their business customers implement this advanced technology in their own operations. So we're still evaluating the implications and potential use cases of generative AI, but our current working assumption is that it'll only enhance the way that our fintech companies do business rather than disrupt them.
All right, thank you. I think it makes sense for us to finish with your broader outlook for fintech going forward. How are you feeling about the long-term prospects for the sector, and what are the biggest risks and opportunities you're seeing right now?
I'd say we're cautiously optimistic. We're a bit more cautious about the near term, as we're still dealing with the lagged effects of the Fed's rapid rate hiking cycle and slowing economic growth. There's obviously risk that the crisis of confidence in the banking sector could worsen from here, even though that's not our expectation. However, we're very optimistic over the medium and long term, call it 12 months out. The secular growth trends across our 7 fintech themes remain very much intact. The shift to electronic payments, the increasing use of data and analytics for decision-making in the financial sector, the electronification of the capital markets, and the ongoing need for financial institutions to modernize and digitally transform their businesses. Fintech spans the largest markets, financials and IT, which collectively represent over a third of the value in the equity markets today. And stocks are down a lot. Valuations are far more attractive than they've been in years. There's a lot of pessimism in the market, sentiment is low, and an economic slowdown is now widely anticipated and likely the consensus expectation. So we believe that we've assembled a collection of the best fintech businesses that will survive in a downturn and thrive in a recovery. And when we look out over a 3 to 5 year time horizon, we anticipate our companies will grow earnings at a mid-teens annualized rate across the portfolio, and valuation multiples have declined to very reasonable levels today, where we expect valuation multiples to either be stable over the next several years or expand from here, which would result in greater than mid-teens annualized returns in the portfolio. So feel very confident about the medium and long term for fintech in general and Baron FinTech specifically.
Wonderful. Thank you so much, Josh. I appreciate you sharing your insights and perspectives with me, along with all of our clients.
Great to be with you again, Liz. Thanks.
I apologize if there are any questions we didn't get to during our session, but we will have your Baron representative reach out to you with an answer. And please feel free to submit any additional questions to questions@baronfunds.com. We will post a replay of today's webcast, and you'll be able to find the details on our website again at www.baronfunds.com. I want to thank Josh once more for his comments, as well as all of our clients for joining us today. More importantly, I want to thank you for allowing us to serve you, your clients, your friends, and family. Our enthusiasm and optimism for the fintech space going forward are unflagging, and we'd love the opportunity to continue the discussion. Take care, everyone.